Good afternoon. I'd like to welcome everyone to the August 2025 edition of the NDSU Extension Agricultural Market Situation Outlook webinar. We'll be following the same format today as we have in the past. We'll have a series of presenters and then questions at the end. We definitely encourage you to ask questions. This is a chance to engage with the experts we have. Today, we'll be hearing from Byron Parman, Frayne Olson, Tim Petry, and myself on a variety of topics. With that, I'll just go ahead and turn it over to Byron.
So I have shown some of these numbers that I'm about to show earlier in the year when we finished with our data set from North Dakota. But the data I'm going to present here comes from the entire FinBin data set from the Center for Farm Financial Management, the University of Minnesota. And most of the data, well, a large share comes from Minnesota, then second would be North Dakota, and then there's some in some of the surrounding states, Illinois, a little bit from Iowa, a little bit from Wisconsin, Nebraska, and South Dakota. But a lot of it's time series trying to look at this northern plains region. And the first thing I'm going to discuss is equipment costs, machinery costs per acre. And so again, this is not just North Dakota. This is the entire basically northern plains, Minnesota, North Dakota, some of South Dakota, Iowa, etc. And these two lines are basically inflation adjusted machinery cost per acre for corn and soybeans. And this excludes fuel and lube. So this would be repairs and depreciation cost per acre for these crops. And I adjusted this on 2009 dollars so that we can go back, because we've had inflation, the last 5, 6 years, and do a more side-by-side comparison of how equipment machinery costs have increased. And when you look at it, especially for corn, you remember when we had the renewable fuel standards and the EISA mandate that occurred and corn prices went up, you see that what happened was machinery costs went from 60 bucks an acre back in 2006 to $100 an acre for corn. And soybeans was not, left behind, obviously, because we use a lot of the same equipment to produce corn and soybeans. Soybean costs went from about 50 bucks an acre all the way up to about $65 an acre, peaking there around 2012. And then for the next, I guess you could say 5, 6 years, we saw those machinery costs per acre come down. And what wound up happening there was it's not that machinery costs actually declined, except in the used market they did in 2014 to an extent. But we started spreading out the cost of equipment, especially new equipment, over more acres, and therefore those costs per acre started going down. Then by about 2019, that trend reversed again. And we saw that corn cost to produce corn per acre went up, cost to produce soybeans per acre went up, and really everything else. These are just the two enterprises that I'm highlighting in this case. And then if we look at, this is also adjusted for inflation from the same data set in 2009 dollars. This is investment, okay, per acre. So this isn't just operation depreciation. This is actual investment per acre. It peaked around 2015 at almost $600 per acre, then for similar reasons started trending down, and then we had an uptick over the last 3 years or so of that machinery investment cost per acre going up fairly substantially. Now, there could be two reasons for it. One, the actual cost of machinery went up, or two, producers were trading off and just spending more on machinery, which would then increase their cost. Well, especially in the last 2 to 3 years, it hasn't been because farmers were buying more machinery than they had in the past. It is because costs had went up. And I show this from the producer price index for farm machinery, a substantial upswing in the 2021 or 2021, 2022. And the other thing is with that high cost, it would have been even higher. There were folks, I'm going back to this in the investment side, who delayed new machinery purchases and put them off, taking more time than they normally would because of these higher costs of equipment, which kind of reduced this to a little to an extent. Now let's talk about real quick land prices. I've shown this chart many times on this webinar and other talks that I've done, what North Dakota's cropland values have done since 2021, up 46%, and last year alone up almost 10.5%. while rents have mostly, I mean, they were up 20% during that same period, 21 to now, but really only, but that's a lot less than 46, less than half, and 4.25% last year. So let's look at the USDA's inflation adjusted farm assets. And we've talked about, or USDA has talked about in written reports on increases in farm wealth. Well, wealth not only includes any revenues or cash reserves or infusions that they have, but also appreciation of real estate assets. So let's look at inflation adjusted farm assets. Well, non-real estate assets are really not a whole lot different adjusted for inflation than they were in the late 70s. Basically looking around that much. But you look at real estate assets, and that's been the big driver in the growth in farm wealth, is just the increases in land prices. That's pretty much explained, and we saw it in the data with land prices going up. They flattened out from that period of 2010 all the way through 2019, and then this big recent surge in land prices that occurred over the last 3 to 5 years. It's kind of illustrated here in this growth in real estate assets. So the increases in farm wealth are pretty much entirely based on this chart, and when adjusted for inflation, all because of land price appreciation. So now let's talk about the income side real quick. So this is again from that FinBin data set. This is our net cash farm income for the net northern region, Northern Plains, Minnesota, North Dakota, etc. And to be sure, 2022 was the highest net cash farm income on record. Let me back up. Sorry about that. 2021 wasn't too bad, and actually, as far as net cash income, 2023 wasn't all that poor when it comes to, now this is nominal, okay, so nominal dollars. So if we want to do more of a comparison, then we'll look at net farm income to gross farm income ratio. And again, 2021 and 2022 were very good years, but they were not as good as 2012. They were not as good as 2010, and pretty much on par with 2007. Okay. So the last 2 years, 23 and 24, this is kind of where we're sitting with basically this net farm income to gross income ratio is just how much of our gross income is going to expenses, right? What percentage is going to expenses in any given year, and what percentage are we able to retain? Well, in our best years, basically what we're showing here is 25%, and the last couple of years closer to 6 or 7%. All right. So let's put some of that into context with our equipment costs and land prices. And the reason I choose land and equipment, land makes up about 83.5% of all ag assets. And we saw it from the other charts, as land goes, so does wealth. But equipment makes up 9%, around 9. So between the two, we're looking at about 92, 93% of all ag assets are land and equipment. So here I'm showing through the data set the rate of returns on assets and equity. Okay. So I want to focus your attention here to 2022, and let's look at the rate of return on assets in 2022. That figure right there is about 8.5%. So the highest net farm income on record, the highest net cash, very high net cash income, and yet it's several percentage points lower than 2012. In fact, 2012 was closer to 13% as opposed to around 9. Okay, and even 2011, 2010, 2007 had considerably higher rates of returns on assets and equity than we had in 2021. And if we look back, 2014 was not a particularly strong year at all, and yet the rate of return on that in 2014 was higher than 23 or 24 for that matter. In 2015, which is pretty much the worst year we've had in the last 25 years, it's only about a percentage point lower than we saw just last year, despite incomes in 2015 being so poor. And then finally, I want to show this one here. And this is U.S. farm sector debt. This chart again comes from USDA, and it's adjusted for inflation. So 1970 to 2025, adjusted for inflation, and I believe this is in 2025 dollars. Okay, so they adjusted it based on 2025. And our real estate debt in the U.S. adjusted for inflation is basically at the similar percentage to the 1980s. All right, so we have as much farm real estate debt as we did in the 80s. When you compare it here, and non-real estate debt has been fairly flat, actually declined a little bit in 2020 and declined in a few years. So most of the debt wrapped up in ag right now is in real estate debt. And I hear a lot of, well, there's a lot of cash out there and farmers are paying cash. Well, they are, but with super high land prices, you're still taking on a lot of real estate debt. And some of that debt, not all of it, but some of it, because you can see it's increasing, is being negotiated at much higher interest rates. I mean, because if the debt's increasing, then clearly some folks are taking out additional loans on higher price land at this higher interest rate. Now, going back to this here, one of the things that was true from 2012, 13 through 2020 was interest rates were low. I mean, very low. 3%, 4%, as opposed to 6.5 or approaching 7 right now. So the question then comes moving forward, if interest rates are let me back up a minute. If interest rates are 3% and your rate of return on assets are 4 or 5, I mean, that's not a great return, but that's certainly workable. If your rate of return on assets is 3 or 4% and the interest rate's 6.5, that is not as attractive. That's showing that maybe there's a little bit of a blinking light if you're thinking about all the sensors in the economy that might give you some warning or pause. The fact that we're getting these low rates of returns, and obviously I'm not the marketing person, that's Frayne and Tim on the livestock side, but I've listened to enough to say that it's not looking very rosy down the road, so I don't see this improving anytime soon, and that's a challenge that we're going to have to deal with here moving forward. Are these asset values justifying the income that we're actually generating? And if not, how long could we exist in that environment with interest rates that high compared to what we're actually able to produce? So with that, I turn it over. I'm just, kind of calling your attention and wanted to show some of the data on what's going on. And again, I don't expect, based on what we're seeing into next year and these fall crop prices, this to be better. In fact, I venture to say it's probably going to be worse when we look back on 2025. So I believe our next presenter is Dr. Olson, and I will stop sharing.
So good afternoon, everybody. Once again, I'm Frayne Olson. I'm the crop economist and marketing specialist with NDSU Extension. Talking about the WASDE report, talking a little bit about, well, mainly the WASDE report today. We can, if there are questions about trade and trade policy and what all's going on, I can certainly cover those. A lot of changes came over last week. We did, and just as a sidebar, I want to, some of my comments are going to be based on new information that I got at one of the national conferences. So the reason we didn't have our webinar last week was because both Byron Parman and I were traveling to a national conference, got a chance to meet with our peers, but also several people from USDA regarding this information. And so I'll try and share and explain that. If you do think of any questions or anything after this recording or after this program, please, feel free to reach out. We'd be happy to try and take any questions at the end. So, real quick, WASDE report for those that have been living underneath a rock was negative for corn, positive for soybeans, and neutral for wheat. And it looks as though things in the markets are kind of stabilizing now based on this new information. Again, trade policy as well as tariff policy continues to evolve very rapidly. I am doing my best to keep up with what the current conditions are. And again, I can answer questions if you have any issues with that. One final point, I just want to remind everybody that yes, when we think about trade and trade policy and the tariffs and what all is happening, please remember and understand agriculture is important, but it is not the leading issue. Okay, agriculture is part of the discussion, but it's typically not the area that causes a lot of conflict. There are a few exceptions, which we can talk about if you have questions. So let's go through the numbers really quick. I just want to give you a brief overview of what actually happened. So this is forecast for ending stocks for old crop corn and soybeans. So this is the corn and beans that are in the bin right now. At the end of August, that will be the end of the marketing year. So on September 1, we'll begin focusing and USDA will update numbers on the new crop conditions. So at this stage of the game, we typically don't see a lot of adjustments or changes. USDA is kind of refining and tweaking their final estimates before we have the September grain stocks report that kind of puts a bow around everything. So very small changes on both old crop corn and old crop soybeans. We did take old crop corn ending stocks down a little bit because USDA continues to increase the exports number. Again, this is old crop, the stuff in the bin from last year. On soybeans, there was a small increase in crush usage. There was a small increase in exports, and that's why we got a little bit of a reduction. So we got a bit of a trimming of the ending stocks for both corn and soybeans on old crop. The big surprise was on new crop. Okay, now a lot of people were looking at and saying, well, we're going to wait to see what USDA says about their yield forecast. And the yield forecasts were much higher. We did get some much bigger numbers, in particular for corn, but also for soybeans. But the shock, which I'll talk about in a little bit, was the shift in acreage. Now, most of the time in the August report, we see some tweaking of acres, but this time it was a pretty substantial shift, and I'm going to explain why in just a moment. So this is ending stock. So what do we think both on the supply side as well as the demand side? We take increase in supply, increase in demand, what happens to our bottom line? That's kind of what influences the psychology within the marketplace. On wheat, there were very few changes. We had a little bit of nibbling here and there, and I'll talk about those in just a minute. Corn was the really big adjustment, a very substantial increase in both planted and harvested acreage, as well as an increase in yields. On soybeans, we had an increase in yields with a reduction of planted and harvested acreage. And so there was some offset going on the soybean side. So notice on the ending stocks, looking at the blue line on top, which was what the market was expecting to see, the highlighted black in the middle is what we had last month. And then you can see on the very bottom, the red row is the one that we actually got. So for wheat, kind of small adjustments, small changes. We did get some increase in the forecast for exports. We saw a slight decrease in total production, which then led us to a slightly smaller ending stock. So nothing really revolutionary within the within the wheat market. Corn, a lot of changes on the corn. So we had about 1 billion bushels added, 1 billion bushels added to production. So we will now have, if this number is correct, we will have a record large corn crop in the United States by quite a ways. Well over 16 billion bushels of corn, which is, again, a new record for U.S. corn production. But because we also increased the supply, there was also some adjustments in the demand base. So as prices come down, we would expect the demand to increase. So USDA did increase all of the major categories in uses or consumption for corn. Both feed went up about 250 million acres, 250 million bushels, excuse me. Ethanol went up about 100 million bushels, and then exports went up about 200 million bushels. So when you run all that through the math and you get to the bottom line, what happened to our best estimate for how much grain are we going to have left in the bin? And it went up and pretty substantially. Again, not only increased from what last month's numbers were, but an increase above what the average trade guess was. Okay, so I will explain in just a minute what were the changes in particular on the production side. And on the soybeans, again, as I mentioned, there was a reduction in both planted and harvested acreage, which I'll show you in a moment, as well as a slight increase in the yield numbers. So total bushels available did reduce, it did decrease. And as a result, because of the decreased production, prices will go up. We had a slight reduction in export demand and the forecast for soybean exports. So our ending stocks, notice that the ending stocks from last month to this month went down, but the market was expecting ending stocks to increase. So they were expecting a higher yield number with pretty much the same acreage number. So this is really the tale of two markets. So the corn market crashed, the soybean market spiked. They are now in, even though there's connected, they're in slightly different mental states, right? They're looking at different things and anticipating different responses. Now, from a production standpoint, the wheat numbers really didn't change a lot. So this is wheat production by class. Okay, and again, the blue on top is what the trade was expecting. The black towards the bottom is what what we saw last month, and the red is what we got as far as numbers. So just a real quick summary, I guess for our wheat markets up in this region, the key was that we saw now notice we saw a slight increase in wheat production from last month, but it was a smaller increase than what the trade was expecting. For Durham, the trade was basically expecting the same numbers, but we got a slight increase. Okay, so we add what's going on here in North Dakota on top of what's happening in Canada, and it looks like we're going to have some very adequate spring wheat and durum supplies on top of some very comfortable winter wheat supplies. Okay, so let's shift to where all the action was at. I know there's a lot of numbers here, but I'll wade through them really quick. So average trade estimates, yep, they were expecting to see an increase in yields. We did get an increase in the yield forecast, but it was much larger than expected. Now, right now, the pro-farmer crop tour is going on through the heart of the Corn Belt. I want to emphasize this is the heart of the Corn Belt. And on Friday, tomorrow, we'll get an estimate of their crop tour. But please understand, it's going to be somewhat biased because of all of the acres and the focus on the traditional Corn Belt states. So we can make some comparisons between what USDA is doing, which is looking at the entire country, versus what Pro Farmer is doing, which is looking primarily at that Corn Belt region. And we can make some comparisons there. There are some correlations and relationships, but I know the market's going to be watching that to see if the Pro Farmer Tour confirms or reinforces the information coming out of USDA. So when we look at yields, this was expected. It was a little bit larger than expected. Notice the total production number. I mean, we added about 1 billion bushels with a B to our total production numbers. So it's going to mean a lot of work to try and find a home for those extra bushels. On the soybean side, yes, we did get an increase in the yields. They were looking at a slight increase from the black to the blue, but it was a much larger increase than what the trade was expecting. The reason, again, that production went down is because we had a reduction in both planted and harvested acreage. So how did USDA come up with those acreage numbers? This is the wild, and I've been hearing a lot of stories in the press, both written press as well as on the radio, and I want to make sure that everybody's on the same page. So in August, USDA surveys farmers and they say, what do you see for yields and yield expectations? So that's where the yield number came from. This is the sampling for each of the states. Notice that they have all 50 states with the exception of a couple in the Northeast. So there's about 15,000 farmers that were sampled or surveyed across the whole U.S. to say, what do you think your yields are now in August? They take that information, they cross-validate it with satellite imagery. So they're using yield estimates from satellites and crop condition ratings, and they're comparing that to what the farmers are saying. They're blending those numbers, and that's how we got the yield numbers out of USDA. For acreage, the acreage numbers, there was a survey done in, well, first the first one is in March where they survey farmers and say, what are you intending to plant? There's a June survey of what did you actually plant? And then in August, what happens is they do they start getting data from FSA, okay? And they cross-check the FSA data for your certification on how many acres did you actually seed with some of the survey numbers. And this August adjustment. Now, normally the survey numbers from farmers from NASS is very similar to the FSA numbers from your certifications. In this case, it was not true. So let me take half a step back. This is the bushels. So what was the percentage change from last year? Where are all the bushels coming from? And notice North Dakota was down a little bit from last year, but we had a pretty good corn crop last year. The yields last year were pretty good. anything with a hatch mark on it shows a record yield. Okay. And again, notice not only the Corn Belt, the traditional Corn Belt yields, Iowa, Illinois, Indiana, Missouri are all looking at record production, but we also have what we call some of the transition areas. Now, Minnesota is really not a transition area, but they've got a record. Wisconsin has a record, South Dakota a record, Nebraska very, very good, Kansas very, very good. Okay, so there's this comment that, well, these transition areas, these fringe areas of the Corn Belt usually pull the average down, and that's true. But even the fringe areas, even these transition areas, are having a fantastic year. When we look at soybeans, very, very similar. Yes, North Dakota's soybean yield is off a little bit, but look at all of our neighbors. You got Minnesota, you got Iowa, Illinois, Indiana, Missouri, Arkansas. All of these are having record yield production projections. Okay, so yes, these transition areas, we got North Dakota and Nebraska that are down a little bit. Texas is down a bit. But we have these really big corn and soybean states that are going to have super, super yields. Now, I created these maps, and I just want to show and talk about this. This is the acreage change. So for corn, when we compare the acres that were reported by the surveys from farmers versus the cross-check data from FSA, the FSA data shows there's about 1.9 million acres more corn planted versus what the survey said. Okay, so anything like in North Dakota, 320,000 acres. So when we looked at how many acres did farmers say they plant in the NAS survey versus what FSA is saying, the same farmers reporting to FSA, there's a difference. And the FSA numbers are showing 320,000 acres more corn planted than the survey results. And if you notice, all of the error, the big, big states where we have big adjustments, North Dakota, South Dakota, Kansas. So Lance Honig, who is in charge of the division in USDA that does all this survey work, I was asking him, I said, sir, hey, Lance, what the heck happened here? And he wagged his finger at me. He said, you got to go back to your guys in North Dakota and say, look, the reason those numbers came up is because in North Dakota, South Dakota, Nebraska, Kansas, Texas, the survey response rates are very, very low. So they try and contact a bunch of farmers in this region and ask them, please fill out the surveys, please give us your information. And they get crickets. Nobody responds. He said for the June acreage report, the response rate in North Dakota was about 30%. 30% response rate, which is horrible. So when you go then as a farmer, if you don't report to NAS, you go into FSA, you tell them the numbers. They use the numbers from FSA to cross-check the survey numbers. And oh, by the way, in a month or so, they're going to use the RMA data as well. So they got the surveys, they got FSA data, they got RMA data, and saying, we're going to get this acreage number as close and accurate as possible. Now, they're not exactly the same. Okay, they're not exactly the same number, but they're very close. And so his point was, if you've got farmers that are really mad about the NAS numbers, the survey numbers, his comment is like, please fill out the forms. If you don't want this kind of volatility, if you don't want this big shocks to the system, fill out the form so everybody knows where we're at. Okay, and that could be positive or negative. I get that. I understand that. So this was the change in the corn acreage. So where did the 1.9 million acres of corn come from? Here's the map. All right, now the opposite thing happened for soybeans. We had a reduction of about 2.4 million acres in soybeans. That's a lot of acres, folks. That's a lot of acres. And where did most of those changes come? Now, North Dakota was pretty close. So the survey and the FSA data are very, very similar. But you get into Kansas, you get into Nebraska, you get into Arkansas, some of these southern states, Louisiana, we got in Mississippi down here, we've got some states where there were big differences. And what Lance is telling me is a lot of that is not procedural. It's the fact that farmers just aren't participating. And so he's frustrated with that like everybody else. He gets an earful every time that something happens like this, but he's saying we are doing the best we can. But we need help, we need participation. So that's part of my plea, but that's also part of my explanation. Yes, we got some really big shocks to the system. There's some people that believe, oh, there's somebody in DC that's just making these numbers up. They're not. They're trying to be as accurate as possible, and they're using the data from farmers to try and do this. Okay, so with that, one more comment. We did get an update on the, I'll stop sharing here so Tim can get his stuff up. We got an update in export sales this morning. Export sales, and I'm looking specifically at advanced export sales. So I'm noticing and getting comments from people that in particular soybean basis levels are really starting to drop. And I mean, I saw a couple elevators across the state that for soybeans, they were at a minus $1.50, which is pretty substantial even for North Dakota standards. Part of the reason is we're not getting really big advanced sales for soybeans. So the international market relies on advanced sales. So if I'm a buyer of soy or corn right now, I'm usually planning 3 to 6 months forward. So I buy today for delivery 3 or 4 or 5 months from now. So those are called advanced sales. And USDA tracks those. And what I'm saying is that the advanced sales for soybeans are down about 20% from this time last year. Yes, a lot of that is China, but not all of it is China. Now, in the flip side, corn export sales for delivery and new crop, for the new crop harvest, are more than double this time of last year. So we're having a very, very good advanced sales for corn, but exceptionally weak advanced sales for soybeans. Okay, and those advanced sales for soybeans are putting a lot of downward pressure on basis. The elevators are getting very concerned. If I contract and buy for harvest delivery right now, I'm not sure if I can turn that around and get it to an export destination, because there may not be as much demand at that export destination as I expect. So the soybean market, even though we're going to have smaller supplies, smaller available stocks, our advanced export sales are also slower. So again, we've got two different market forces moving in the opposite direction. All right, with that, I'll take a pause. I'll be happy to answer any questions. I'll hand things over to Tim.
Good afternoon, everybody. Tim Petry, Extension Livestock Marketing Economist. And I'll just kind of mention, glad that Frayne talked about corn, because I'll just kind of mention that when we get to feeder cattle. But anyway, start off like I promised last time. USDA did issue on July 25th the July cattle inventory report. It was a non-event, really, because the problem was last year, because of budget constraints, NAS did not do the July report, so we had nothing to compare to except for 2 years ago. And we figured that the numbers would be down from 2 years ago, because on January 1st, that was the 6th straight year of declining numbers. So it would have been really nice to have the report last year. And so, I'm urging producers and others to, when they talk to their congressman, to say it's important to fund NAS and these reports, because it may well have, and I think probably we are increasing the beef cow herd a little bit, and which is the big question now. So we don't know what last year's numbers are. My guess, with looking at replacement heifers and everything that went on, and by July 1st, that possibly on last year, if they'd have done it, we may have had something like 28 28.5. That's my guess. It's not official. This year came out then to 28.65. So that would have showed a slight increase in numbers. But again, that's very unofficial and we don't know. And that's the problem when we don't get survey data. One thing that we did find out there with that 28.65 number is that was 2.8% above the January estimate, which was 2786. It was 2.8% above. And the July numbers are, when they're done, are always above the January numbers because the previous year's bred heifers, they are now cows on July 1st. They were bred heifers when the survey was done on January 1st. Now they're cows because they had a calf, so it's always larger. But during the liquidation phase, it isn't, much larger. Last year, if it was 28.5, it would have just been up a little bit. But this year was up 2.8%, which was pretty much identical to back what it was in 2014 when we did have some increase in numbers there. So, that's just kind of my hypothesis that we did increase the herd a little bit. A lot of indications of that. I've showed you this map before, and this is where the change in beef cow herd occurred last year. And the largest beef cow calf states, as I've said before, we start at Texas, go up to Oklahoma, Missouri, on up to Nebraska, Kansas, or South Dakota and Montana and so on. We're number 8. And so last year in 2004, 6 of the top 10 states did increase numbers. Texas did, Oklahoma, again, Missouri, North Dakota, Montana, come down here to Florida. And although on January 1st, the numbers went down almost 150,000 head. And in those very important states, they went up almost that same amount. So there was herd rebuilding going on last year in the major states. And the main reason, again, for that is because weather has improved, and particularly it improved between now and July 1st when the July 1st survey was done. On the right-hand side here is our weather back in October of 2024. But by now, remember where all that on the bottom and dark is where the cows are, like I just mentioned. By the end of last year, 60% of the cattle were in drought, and now only 15%. And just looking at, Texas right on up through North Dakota, where the cows are, how much improved it is. And North Dakota is drought free, except it's a little abnormally dry still up in the Northeast. I know, not a good year for making hay, and probably maybe for combining wheat too. But anyway, it's good for pasture conditions, and so another reason why probably the beef cow herd has started to increase, at least a moderate fashion, because we didn't have a lot of replacement heifers. And so, here is the July 1st. Again, we didn't know how many replacement heifers we had last year. I'm thinking we probably had about the same last year as we had this year. One important thing that the report did tell us that is, positive for prices is it's the first estimate every year. Last year we didn't get the estimate, but this year is the first estimate for this year's calf crop. And so this year's calf crop at 33.1 million head there, again, is down. It's the lowest for many, many years. Similar calf crop the last couple of years, but this year down again, which means we're going to have fewer calves to sell this fall and have fewer cattle. And so, again, one of the reasons why prices are where they are. So, again, the major things that affect feeder cattle prices are First of all, the supply, and we know that's lower, and a little bit on that in a minute. Then it's fed steer prices, particularly those futures markets in the distance when those feeder cattle would reach slaughter weight. And then the other thing is corn prices, and Frayne alluded to that everything is going in the right direction. Our supplies are low, corn is low and under pressure. And then on the fed cattle side, fed cattle prices are doing really well. My charts are all the same here. Red is this year and light blue last year, purple 2023 and green 2022. But last year fed cattle prices were very similar to 2023, and a good reason for that, because beef production was about the same. And the reason why beef production was the same, even though the cow herd went down, is we added 30, 40 pounds to every steer and heifer that we killed, which is comparable of about 1 million more cattle being killed and we made it up on weight. And in 2023, we lost 1 million cows, so we made up all the 1 million cows we lost with the additional weight on cattle, so it's the same. But now, this year, although weights are still a little bit higher, slaughter of everything is going down because of the lower cow herd and the lower numbers we have. So far this year, steer slaughter is off 3.4%. Heifer slaughter is off 4.2%, which means now we are not slaughtering as many heifers and keeping them. And beef cow slaughter is off 17%, which means we're not selling as many cows and keeping. So just some more reasons why modest herd rebuilding is probably going on, particularly where the weather does that. But back to fed cattle prices this year then, with the lower numbers and very strong demand, mention that in a minute, is that, prices are just every week almost a all-time record high. And so here we are last week at 242, $53 a hundredweight higher than last year. Last year they were kind of on a little seasonal decline there. And so just record high prices. Here's the futures yesterday up there at 238.5 and so on, and a little change in the futures market today. So looking at continuing that record high pace, which is very, very positive to feeder cattle. And then the gold numbers are next year as well. Some risk off by the end of the year there from this year, but that's just the futures. Actually, with the big increase in numbers here, USDA is trying to catch up on they predict an annual price for feeder cattle, and they have made quite significant changes just in the last WASDE report. They were, the previous month they were estimating 221 for an annual price for this year. And so this new WASDE report, they increased to $5, which is kind of unprecedented for them to make that much change in 1 month, but up to a yearly average of 227. But as of now, as if they stay up there, that would be the case. And then for 2026, they next year they have been predicting 228, which isn't a lot different than the prediction now for this year. But in last month they raised next year's price forecast to 243.50 from 228.50. So again, just kind of an unprecedented increase estimate based on what's going now in the prices. So obviously positive for feeder cattle prices all the way down. Demand is holding very, very well, more than many people thought. The cutout value is what the packers can sell meat for into the, into the wholesale, retail, export market. And you see the cutout value last year again was about the same as the previous year because beef production was the same. But as beef production has fallen off this year, so far total beef production off 5.3%, and demand strong as well. Demand is the other side of the picture, and demand has been very strong there. And so we did move up seasonally like we usually do with the early summer holidays, Memorial Day and so on, 4th of July, then back off seasonally and then see a little spike before Labor Day. And this year we're seeing a really nice spark again, indicating very, very good demand. This week, we've averaged over 400 every day, 408 today. And so next week, that line is going to go up again to record high beef cutout values. And that funnels back into what, packers can pay for fed cattle. And so that's why they're up. So, here's the July 1st residual feeder cattle supplies outside of feedlots. And again, the lowest on the chart here. So we're going to be short of feeder cattle. And then, add to that, I didn't bring the chart, but our border, Mexican border, is closed because of screwworm. And right now we'd probably be getting maybe 15,000 head a week or so from Mexico, and we're getting none. So supplies are very, very short. So those short supplies, corn prices, low, and fed cattle prices high is sparking these 550 to 6 weight calf prices. Right now they're $100 higher than they were last year at this time. Last year we saw the seasonal decline occur earlier because of dryness down south and early movement of calves and some things, but they're still going up. Average last week there of about 415 or so. But again, when the calves start coming to market, that is going to pressure the market, and it's going to go down seasonally, but still it's well supported at record high levels above last year. And again, a wide range in prices. Right now they're probably 556 weight calves selling for probably 440 and some for 390 or some. So there's that $30-$40 range of the same weight and grade of calves at the same market, and that's going to continue. So just, one price doesn't tell the whole story, but anyway, you see just very, very record high prices there occurring $100 above, and will be supported at higher levels for this fall. It's good news for those selling calves. Same thing on the yearling side, the same story with corn prices and fed cattle prices and what feedlots can pay and so on. So, we're up there at 358 or something, and there's the futures market. The rest of August, September, October, November, saying about it at those levels. So just unprecedented times for us. But that doesn't mean that there is risk. Frayne talked about the corn market, but the corn isn't in the bin yet. And things can happen in the economy and geopolitics, and Ukraine, Russia situation, in the Middle East situation, and all that. So, we're going to start looking at backgrounding programs this fall, and so I would not necessarily throw price risk management out the window just because we're at record high levels and it looks good, because you're going to put the highest price cattle ever, even though if they're even your own cattle, the opportunity cost for selling is going to be high prices. And so so I wouldn't throw that out the window. So just finish up here. Here's the August feeder cattle market, futures market. That's very, very volatile, and that scares a lot of people, but that's just the nature of when we have these very high prices. Yes. And one thing to watch is, when that futures market gets above the cash settlement price, here the last Thursday in August, these two will be the same, the cash settlement price and the futures market. So, we've seen that happen in the past. That futures market gets above the cash settlement price, and then we have a big adjustment downward. A couple of weeks ago, down $9 one day, but then it keeps up with the cash market. Right now we're that. So if when you're interested in, say, doing an LRP contract or something, watching for those times, because the livestock risk protection or futures market options are based on the futures market price, but they're settled out on that cash price. So right now we're $10 difference between the August futures and the cash settlement price, and they'll be the same here at the end of August. So I usually been showing lamb prices, and so same story here as repeating myself, and like the cattle here the last time, lamb prices are doing very well. At last month they were the same the last 3 years, and then of course in 2020 3, they held pretty good, but we usually do a seasonal decline that I would expect to happen again. Last year, the seasonal pattern was more pronounced. And again, there was a lot of dry weather in lamb country and movement and so on. So, the way it looks now, probably following that more the 2023 seasonal pattern is not the abrupt drop that happened before. With that, stop sharing, turn it over to Dave.
Just give some brief remarks about what's going on in corn and ethanol. Frayne's already laid the foundation for that. Not the most earth-shaking news, but one of the things we can think about, and we always talk about, at least when students are undergraduates here at NDSU, is this relationship between total supply within a market and price. And of course, with the discovery of a few million acres of corn and increased projected production and supply, we're having this price response. This is a slide that I've used over the years, and I'm going to bring it back at least for today. We'll see how long I keep it. But this is a picture of my dad in front of a pile of corn where he's getting ready to bait some deer. But anyways, looking at some information from what's been going on. So if we look back for the last few decades, and we've had this dramatic increase in corn production driven primarily by yields. And of course, now this year we have record-breaking yield as Frayne showed in many states, as well as, a number of acres planted. And I like to pair that up against ethanol. So one of the justifications for the renewable fuel standard 20 years ago was looking at energy security, the environment, but then also managing supplies and what it would mean for the ag economy with that additional demand. And if we go back, this is measured in terms of bushels, either produced for the yellow line or that orangish line, or that which is used for ethanol, which is the gray line. And if we actually go back to 2025 when the RFS started, we've essentially already outgrown all that additional use. And so in a year like this, where we are going to have somewhat increased production of ethanol into next year, increased production of ethanol, but also this really large supply, it doesn't offset things like it used to. Can also break this up with a Sankey diagram, and this kind of helps people understand exactly where the corn is going, and especially that relatively large role of ethanol. I think it's helpful because it is such a large market, but to put that in a visual. But then if we actually step back and realize that, about a third of that material goes back into the feed market, the actual percent of material that's going into ethanol, the carbohydrates into sugar, into ethanol is a bit smaller. And of course, if we go back 20 years now to 2005, that almost 4,000 bushels is less than what we've added in terms of total production. Another thing to look at, I thought it'd be interesting to look at stocks use and prices. So stocks use is the ending stocks divided by total disappearance for a year. And we oftentimes plot that against price to see what the relationships might be. And we saw with this additional this additional projected production of corn, that increase is going to increase stocks disproportionately. And we're going to have relatively large stocks, at least relative to the last few years. And then prices are from WASD are $3.90, nationwide for what we would expect a farmer to receive. Of course, it'd be different here in North Dakota. Another question, something I'm definitely going to take a little bit of time to look at. In many cases, North Dakota gets a little bit of a whip effect on this because we don't have as much in-state demand, especially on the livestock side, and so that change in basis could be even more pronounced going into harvest. Again, kind of depending on how things go. The silver lining, and again, there's not a tremendous expected increase in ethanol production. Again, that was, WASD had that there as well with that 5,600 number. That is for 2025, or the marketing year of 2025. We've had record exports, maybe see that continue. There's been news just in the last month of mandated blend rates in India and Vietnam, which are relatively large markets, especially when you're going from almost zero in India to 20%. in just a few years. Domestically, what we might be able to see again, if these low corn prices might be able to drive a bit of production and, keep ethanol profitable, but, get it to more consumers. Could that end up being in the form of more E10? Again, in this part of the country, E10 is pretty much universal. You have to go and search and find out and search and go find a E0 product, but that's not true, especially like in the Southeast. Might we see more ethanol used there? Possibly. And then, of course, too, there's this opportunity for E15 growth. It's going to be, a bit more difficult. That ends up being kind of a structural thing, having people shift or be first-time buyers of E15. So there's no easy outlets for this increased corn on the ethanol side of things. Those are the remarks that I had. I'm going to open it up for questions here. I know that we have one already. We will be back next month, back on our regular schedule, which is the Thursday after the WASD report. And that'll be September 18th. But with that, I'll turn it over to Frayne.
All right, so let me pull up the question here. So when you talk, this is the question. When you talk about the pressure on soybean, would this be the same as the soybean crush plants? Meaning that if we ship those harvested beans to be crushed, the exports are still weak even for crushed soybeans. Well, yes and no. So the local crush demand has to compete with the international market. So when you make as a farm manager, make a decision, do I sell to a crush plant? Do I sell to the elevator? And then if I sell to the elevator, what does that elevator do? They put it on a train and move it out to, for example, the West Coast, where it gets on an ocean vessel and leaves, or do they store it for a bit and then try and supply the crush plant during off season? So the answer is, well, it all depends, right? My favorite word in the English language is it depends. So as of yesterday, I looked up this information for yesterday. I don't have the closing prices for today, but when I look at the crush plants, both Spiritwood as well as Castleton, for harvest delivery October, they're both at minus 95 cents for their basis. So minus 95 delivered to a crush plant at harvest. There's a couple elevators that I looked at that can deliver either both directions or within that region as a supply chain, and they're minus $1.25. So that's about a 30-cent differential between what the crush plant will pay and what the elevator will pay. That 30 cents is actually very common. When I've been tracking this over the last several months since the crush plants have been coming online, 25 to 30 cents is a really common spread or differential between a crush plant and an elevator. So that's a really fancy way of saying that the crush plants really only need to bid the price just high enough that the soybeans don't get on a train and leave the country. And it's the same thing with the ethanol. The ethanol plant only needs to bid for the price of corn just high enough that it doesn't get on a train and leave the region. So when we think about basis levels, they are connected, they're linked. And so my comment before was one of the reasons, there's two main reasons we're seeing kind of this downward pressure on basis levels. We normally see basis at harvest be pretty low. That's typical, that's a seasonal pattern. But these seem to be and feel a lot lower than what we've seen over the last several years. And in my opinion, there's a couple things happening. It's both the inflow of grain and the outflow of grain. Regionally, within this area, it looks like we're going to have a really good soybean crop again. It also looks like we're going to have a fantastic corn crop. So storage capacity is going to be at a premium. Being able to move the grain not only at harvest but later on the season is going to be at a premium. And so the inflow of grain into the system is going to be relatively large. And I guess my comments before is typically at this time of year, we have these export sales that are already on the books. We've pre-sold some grain into these other markets, and they're just waiting for the grain to hit the elevator or hit the system to be able to push through the system and be able to deliver it on time. What I'm saying is those pre-sales are smaller than normal. I'm not saying that they won't appear later on, and it's very likely they will appear later on, but this is a matter of timing, right? And so because the inflow looks like it's going to be pretty large, we're going to have a really good crop locally. The outflow looks like it's less than normal because typically we have more export sales, in particular through the PNW at this time of year. As a result, the basis levels are starting to widen. So what it really it's saying is your local market is saying, look, we can only handle so much grain at harvest. Just be careful that you understand we can't handle as much as we normally do. Okay, so the local market is signaling to farm managers to say, look, we're going to have some challenges, at least based on everything we know today, being able to handle all of the inflow given the lighter outflow, at least for soybeans. Okay. Now for corn, our basis levels for corn are also a bit more negative than we would typically see at this time of year. But again, in my opinion, it's not the export market that's driving that. That's primarily just we know we're going to have this massive crop. There's going to be a lot of corn around. There's actually some corn from last year that's left over. You know, there's plenty of corn around, so now it's a matter of trying to meter that or regulate that flow throughout the system. So hopefully that answered your question. Okay, Frayne, have you heard anything about China considering duties or tariffs on Canadian field peas like they did for Canadian canola? What impact would that have on U.S. crop? I have not heard anything yet. Obviously, a lot of press about the canola issue. I have not heard anything about Canadian pulse crops, either field peas or lentils. Field peas is the most price sensitive. If they did that, if that happened, there would be an impact. Now, the flow of peas and lentils into the Indian market is much larger than the flow of peas into Chinese market, but there is a flow there. So again, anytime we have kind of the restriction of trade, it's going to put some downward pressure on field peas. But I have not heard of anything yet. You know, I try and keep my eyes and ears open, but I've not heard of anything yet for that. Okay, so have you heard of any elevators telling farmers to plan on storing soybeans on farm because they won't have room and the price may not be favorable? Short answer is yes. I have heard that. I don't know that it's terribly widespread. You know, I don't know that it's like really common around the region. But yes, I've been hearing that the elevators are concerned about their ability to store grain, both corn and beans. I think they're a little bit more concerned about beans simply because there's more uncertainty about being able to push those through the system. Is there going to be an export demand or an export bid that will be sufficient to be able to move those beans through? On corn, we're having some really good corn sales. So these lower prices, we're having some very good corn export numbers. So again, I think even though we're going to have a very large crop, the elevator's a little bit more comfortable taking in a lot of corn and even potentially storing it on the ground, knowing that they can get it turned around pretty quickly and move back through the system. So their storage loss will be smaller than if it were to sit there for several months.
Great, thanks, Jeremy. I think we're good. There's no more questions, and Frayne looks exhausted. So we'll put a pin in it for today. Again, we'll be back in September, and if you have other questions, you know, feel free to reach out in the meantime as well. But I'd like to thank our presenters and everyone for attending here today, and we'll see you guys next month. Thanks.